Realtors, welcome to the SCR webinar series sponsored by Realtors Education Foundation, REF. Our show today will be an overview of the USDA Single Family Guarantee Rural Housing Loan Program. This program is geared toward mortgage lenders and brokers. Our speaker today is Bert Koon of the USDA, and off camera is Loretta Friday. Bert Koon is a 34-year employee of USDA Rural Development in South Carolina. He has been Single Family Housing Program Director since 2001. Bert is a graduate of Clemson University and is married with 4 children. Thanks for being with us here today. We'll now hand it over to you, Bert. Thanks.
Thank you, Byron. I appreciate an opportunity to meet with you guys today. Appreciate South Carolina Association of Realtors for having us out. As Byron mentioned, we're going to do an overview of the guarantee program under USDA. Before we get started, just a little bit of background information. Rural development is the finance leg of USDA. We finance generally anything except agricultural production commodities. We have 4 or 5 major programs. That would be single family housing, multifamily housing, community facilities, water and waste, and business loans. We have about 90 employees statewide with 10 offices. But today we're going to start talking about the guarantee program, and it's just that. It's a guaranteed loan made by an approved lender, and we're going to get into some of the processes and procedures for the guarantee process. This program is generally geared toward a lender training. If you have questions, please let us know, and we'll try to take the program whichever way you guys would like to take it. Generally, the program mission is to serve low and moderate income borrowers in rural counties, to provide adequate, modest, safe, decent, and sanitary housing, and the guarantees are made in situations where the loan would not be made without a guarantee. Some of the highlights are 100% financing, there's no loan limit, there's your qualifying ratios. All the loans are fixed interest rates with 30 years for 30-year terms. No reserves. You can't have gifts, grants, or buy downs, and it's not limited to first-time home buyers. It's a 90% loan note guarantee, and there's the examples of on a $150,000 loan, the maximum loss claim that could be paid to the lender would be $135,000. All the loans are made at 100% of the appraised value, and it can include the upfront guarantee fee. If the appraisal comes in, or the sales price comes in at lower, appraisal comes in, at a lower appraised value, then there is some room for eligible costs, lender fees, and so on. The purchase price will equal the appraised value plus the guarantee fee, and then there's no maximum loan. The structure is there's a 2% upfront fee paid at closing with 1/3% or 0.3% annual fee for purchase loans, and refinance is the 1.5% and 3% annual fee. This is a good website to refer to if you want to look for guarantee fees and annual fee calculators. You can see the process 1, 2, 3. That's a good website to look at some of the financing features of the program. Here's an example of the guarantee fee calculator that is in that and linkable under that website. The upfront guarantee fee can be financed, or a portion of it can be financed, or none of it can be financed. And the number 2 there talks about how you would figure out what the total loan amount would be. Base loan amount divided by the reciprocal will give you the total loan amount. You see it down below. With a 2% fee is 0.98, and the 1.5 refinance is 0.985. The annual fee is calculated based on the average annual unpaid balance. Basically, the annual fee divided by 12. 2 months can be escrowed. It's included with the PI-TI ratio, and the lender may collect an escrow fee. GUS, or the Guaranteed Underwriting System, which all your approved lenders will be aware of, or most of them will be aware of, will calculate the fee for the lender. As an example of an amortization scale, which includes the fee. Again, on eligibility, a person who does not own a dwelling in a local commuting area or owns a dwelling which is not structurally sound or functionally adequate. Cannot own a home in the local commuting area. If a retained home is within the local commuting area, it must be structurally unsound or functionally inadequate, overcrowded, so on. We can only retain one dwelling along with the guaranteed loan, and the retained dwelling cannot be financed with a direct or guaranteed loan. Applicants have to meet the other credit eligibility criteria. Basically, if you're qualified to obtain your credit needs at conventional sources, we'll ask you to go there. You must be a U.S. citizen, you have to be legal age to obligate yourself, and you must occupy the property personally. There's some of the tests for conventional credit. If you have the 20% down payment in your reserves, money to pay closing costs, there's the ratios generally that are used in conventional circles. No adverse credit per the lender's guidelines, and acceptable credit history. And we do not require private mortgage insurance, which is generally required in conventional sources. We talked about a little bit about eligibility. Now we'll talk about the property eligibility. Again, it must be in what's considered an eligible rural area. There are 19 counties in the state that have ineligible areas, and you can see those on your screen. The rest of the counties in the state are all considered eligible. This is a good website to go and check a property for eligibility regarding being in a rural area or not. This site also has a lot of good information about all programs under USDA rural development. But if you go to that site, on the left side, you click on single family housing. You'll sign or accept or decline a disclaimer. You see the United States map, and you click on South Carolina. And then you can either type in the address on the left side or the zip code and punch get map, and it'll bring up the location on the map. This particular one shows this and is eligible. This particular address shows ineligible because it's in the shaded area, which is considered non-rural. Sometimes you'll see one where it'll come up as unable to determine, and generally that's in new subdivisions or unnamed roads, or for some other reason it's not showing up on our database. In that case, you'll need to really contact our local office or our coordinator and have somebody do a personal check. There's some of the eligible housing. The housing has to meet HUD handbooks. Condominiums must be Fannie Mae, Freddie, HUD and VA approved. PUDs are eligible. Modulars are eligible. And for manufacturers, we're only going to do new units with an approved dealer contractor. And new construction, you have to have certified plan specs and a builder's warranty. We don't allow income producing properties. No rental homes, no large farm service building, grain bins, agricultural buildings, cell phone towers, or any income producing properties, if you will. We get a lot of questions about lot size and acreage. Again, it can't be an income producing property, and the value of the site can't exceed 30% of the total loan amount. If it does exceed 30%, it has to be typical for that area, and it cannot be subdivided into 2 or more sites. Again, going back to the same website, if you go down a little further, it'll come into income eligibility, and we'll talk about that for a minute. Again, this is on the website we just mentioned, and you can go into this site and punch in the number in the household, students under 18 or minors or children under 18 or disabled or full-time students. Check whether there's a co-applicant or age 62 or older and a disabled person. Take you to the next screen. You fill in the monthly income for the applicant and other household members.
Asking if you know what the eligibility or what address is. I think, hang on one second.
If you go back,
Let me check something real quick.
Right there.
there it is. Someone had asked about an eligibility website. It's posted on that screen. Go ahead. Again, this is an example of deductions off of annual income, child care expenses, medical expenses exceeding 30% of the gross, medical and related expenses exceeding, 3% of the gross. Going down, you fill in your monthly income amounts. It'll bring up a screen that applicant is eligible or ineligible, and basically give you an analysis of the total household income, total deductions, the adjusted income, the maximum household income for that state and county that you selected, and then the adjusted. You might see there on the bottom two, the 502 guarantee limit is much different than the than the 502 direct loan limit. There again, there's three distinct incomes. The annual income is a one-time calculation. The adjusted income is the annual less the deductions to give you an eligibility amount. And then a repayment income is the stable and dependable income of the applicants that will be on the mortgage. Document incomes in traditional ways, the verification of income, verification of employment, one pay stub and year-to-dates, or 30 days of pay stubs, year-to-dates, and 2 years of W-2s, plus a telephone VOE. Self-employed is a little more difficult. You can see the kind of the things we ask for on documenting self-employment, tax returns, year-to-date, profit and loss, and income and expenses. There again, some of the documents you can use to document self-employment. Again, some calculation examples about how we'll project income on a monthly basis and into a yearly basis. This slide talks about averaging year-to-date earnings and projecting out to 12 months worth of earnings. Another way is looking at historical year-to-date calculations, along with documenting our backup W-2s and tax returns. Another suggested year-to-date gross earnings divided by intervals and number of calendar days projecting total. Again, the income calculation is a crucial calculation. By law, loans have to be made to low and moderate income applicants, so it's very crucial that we document and calculate incomes correctly. In reviewing the income, there again, consider the types of income, whether it be bonuses, commissions, so on, the history of the type of income, the time of year that you're trying to project into a yearly basis, and a logical calculation. This is an income worksheet that's available online. When we look at these loan requests, we don't re-underwrite the loan, we will review the income calculations. This is a suggested form to use in presenting your application and your income calculations. Not sure why that's in there, but that's the one I was interested in. Why it goes back to the 19 counties with some ineligible area. Credit's another area we look at real closely. We look at on the tri-merge report, the 3 scores, take the middle score, 2 score, take the lowest, 1 score, no score. You got to do your non-traditional credit sources, and then on repeat scoring, you can use the 2 that are repeated. You can look at some of the indicators of unacceptable credit, foreclosures, tax liens, delinquent government debt, judgments that are in non-pay status without being addressed. Any federal judgments or liens must be paid in full or satisfied. Again, some other indicators of unacceptable credit. Again, credit waivers. Generally, we look at a 640 credit score or better to avoid requests for credit waivers. Credit waiver is underwriter discretion. Its circumstances must be a temporary nature beyond applicant's control and have been removed, generally due to some loss of income, illness, death, and so on. This is an example of a waiver that's probably not going to be acceptable, just stating that it's temporary in nature beyond the control, unlikely to occur. Whereas the applicant lost his job, 2 weeks later they broke their leg, insurance is slow to pay, the applicant's being reemployed now for the previous 18 months, and therefore the average credit is unlikely to occur again in the future. So this is the kind of documentation we'd like to see if you request a waiver to the credit. Again, there's a form in which you can analyze the income and request a waiver to us. The ratios generally are 29 and 41%. Again, the ratio waivers may be requested with strong documentation, compensating factors by the lender, and the ratio request, or waiver request, excuse me. Interest rate is agreed upon with the applicant and the lender. The maximum interest rate is determined the day the rate is locked and can't exceed the Fannie Mae 90-day plus 60 basis points. This is a general overview of the process. You interview your applicant, submit the file to the underwriter. Underwriter submits the file to us. We issue a conditional commitment. The lender closes the loan, and we issue the loan note guarantee. That's generally the process. Right now, we're looking at 5 to 7 day turn times from when we receive the file to issuing our commitments, or at least working the file. There's the forms that we require to be submitted in a completed application. The 19A21 is the request, the uniform application, the appraisal report, the underwriting transmittal summary, credit report, income verifications, the contract, and the floodplain determination. So it's not a lot of documents. And you'll only need to submit these if you need to. And you see that. Verification of rent, credit waivers, debt ratio waiver documentations, and any other additional information that you might feel we need, especially in a file that's considered a refer or a full document file. We're going to review it for completeness, make sure the applicant's income and property is eligible, and it's an eligible loan purpose. We'll look at repayment abilities, collateral. We'll do the environmental review, obligate the loan, and issue the commitment. We do return incomplete application packages. Any denials are made in writing and with appeal rights. Again, there's some examples of the forms we use. That's the actual request for guarantee. And this is an example of the actual loan note guarantee. Cash at closing, the buyer cannot receive loan funds back at closing. However, some fees can be returned. That's your earnest money deposits, insurance, prepaid insurances, loan fees, appraisal fees, prepaid repairs. Do not give cash back for tax credits, excess funds versus loan amount, excess seller concessions remaining, unpaid, or items paid with credit cards. Give you an idea of the size of the program in 2011, this is roughly 2,850 loans for $370 million. And as of July 12th, we've done 2,282 loans for a little over $300 million. So it's a very popular program. Again, we process somewhere in the neighborhood of $1.5 million worth of guarantees every day. These are some good websites if you're interested in the program to go to. Again, USDA.gov, you can link to most of these sites off of that main site. If you can see down on the bottom left, you can click on regulations and guidance and look at all the regulations regarding the programs, and all programs for that matter.
You tell them that the links are on the left side of the page in the webinar right now, so.
But you need to back me up.
If you guys want to visit any of the pages coming up, they're all linked on the left side of the webinar under web links.
Sorry, here's a list of some other links also. Most everything we've talked about today is linkable on one or more of these websites that are listed. We appreciate the support. We appreciate your time. Hope it's been something you can use, and hope to hear from you soon. If there's any questions, we'll try to get them answered.
He asked if there's a place where we could get the slides. Could they email you?
Sure.
Okay. You could let me know.
We had a question about these slides or this program. If you'll email me, I'll try to send it to you right away. My email is bert.koon@sc.usda.gov. And just refer to it as the guarantee presentation or the guaranteed loan presentation.
If a realtor wants to use a USDA loan, what's kind of the process? Do they contact a mortgage broker, or you guys recommend?
Well, Byron asked about how to start. Yeah, you would just contact either an approved lender or any licensed mortgage broker in the state that's familiar with our programs. And most all your major lenders are approved. Some are more active than others, but yeah, just get started through a broker or a lender who's familiar with the program. If the lender or broker is not familiar, ask them to contact us, and we'll guide them through to get them started and take it from there. The two main things to take from this, I think, today is that you have to be low or moderate income, and that's published through the HUD guidelines by each county, by family size, and you have to be in rural areas. If you have an applicant with acceptable credit history, who meets the moderate income requirements, and wants to live in a rural area, you ought to get the guarantee. In theory, the guarantee will give the applicant negotiating power with the lender regarding the interest rate. So it's an excellent program, 100% financing, no PMI, and it's just as good of a federal-backed guarantee program as I've seen in my 30 years plus of government finance.
Bert, I saw you guys are doing a high volume this year. What's kind of some turnaround times realtors can expect?
Yeah, Byron, we right now we did get behind a good bit back in May and June. We've implemented a plan here in the last 3 or 4 weeks to address our backlog, and right now we're doing about a 5 to 7 day turn time from the day we receive it, and that's working days. So give you an example, we're working today on stuff we received last Friday. So we're about 4 working days out right now. We have a plan in place that once we get to a certain point, the overflow will move out to some other staff, and so we hope to maintain that 5 day turn time in the future.
I think that's it. All right, if you want to just say.
Well, again, I appreciate the South Carolina Association of Realtors having us out. We are available to you. Look us up on the internet, contact us, and if you have problems or questions, let us know, and we'll try to get you through it. Thank you.